Check, please.
Welcome back to Everything Money. In this video, we talk about Google's recent stock split, Paul. I read comments all over the internet about what a stock split is, how people react to it, how investors are excited. Some people say, now I can afford it. We're going to go through Google's financials, show you if you should be investing in this company. We'll show you the stock analyzer tool, what you should be paying. And this might get a little murky, Paul, with how a stock split works. We know in general, spoiler alert, it's just a marketing ploy, and we'll tell you why. Paul, give us all the info on Google and their 20-to-1 stock split, baby.
So I read an article last night that said Google is now cheaper.
Boom, boom, boom.
And of course, I put my head down and I said, oh, they don't understand what that means. Guys, when I hear something's cheaper, I hear the price is less. And you might sit there and say, yes, the price of Google stock's going to be less. It's going to go from, it's going to be a 20-for-1 split, right? And right now, the stock, I saw it at $3,000. So 3,000 divided by 20, it's going to go to $150. Paul, you're stupid. 150 is less than 3,000. It is cheaper. Okay. So here's what I think when I think cheaper. Let's go to our Everything Money software right here. I'm going to go to the 8 Pillars tool. I'm going to type in the GOOG, go to Alphabet. Here's what I hear when I hear cheaper. This is the market cap. This is the price to buy every share outstanding. Is that going to go down by 95%, divided by 20? It will not. Why? Because all they're doing is instead of $3,000 per share at how many shares? Call it 6 billion? 6 billion, no.
600 million.
600 million? So they're now going to have $150 a share for 12 billion shares.
Oh.
That's all it is. I didn't hear anything cheaper. All I saw here is 1.8 trillion either way.
So I do know that some people who can't buy fractional shares on their brokerage account.
Now, this is where Google's sitting there saying it makes people feel like they can buy more shares, therefore they like it more. And by the way, for the options market, this is great.
That's right.
Because before, at $3,000 a share, for every
it.
option you do, you have to do 100 shares in 100 share blocks. So 3,000 times 100 equals 300,000.
We can do that math, Paul, but what about...
At 150, now all you need is 15,000 to do one contract.
There you go.
It's definitely very, very beneficial for the options, for people to get more into options. And Google uses it as a way to drive up price, because now people say, oh my God, it's only 150. Let me go buy more. And when you look at Apple, and you look at Tesla, and how they did stock splits and their stock skyrocketed, Google's just taking advantage of that.
You know, I'm looking at the day trading chart for Google, Paul.
Yeah.
And it's, I think, it's still up. I mean, obviously it skyrocketed last night.
It's up 6% right now, but it was up like 8% last night. It was at the last time I saw it was $3,005. What's it at right now?
$29.21.
Okay. All right.
So there was some excitement. It's falling off a bit. Why do companies like Google do this, Paul?
They do it purely to get people excited about the company and to want to buy more shares, because they feel like, oh, before I was able to buy 1 share, now I can buy 20 shares. This is wonderful. This is great. This is awesome. And that's all it is. It's just somebody feeling like they can buy more shares. I remember in high school, I'll never forget this. I've told this story 1,000 times, being an Algebra 2 trig, and Mr. Ritchie said, I'd love to own Nike stock, but it's too expensive. I remember back in high school going, that's not what that means. It's just not, it's like, it doesn't make any sense to me. You're sitting there saying a Ferrari for 300 grand is more expensive than buying 1/20th of it for 15,000. It's this exact same price. You're paying the exact same price for the car. You're just getting, all you're doing is splitting it up in more ways. That's it. That's all you're doing. Okay, if you want to feel like it's cheaper, go ahead. So, guys, what we're going to do now is figure out if it actually is cheap or expensive or anything relative to value. Price is what you pay, value is what you get, okay? That's what we do on this channel. We focus on that. Now, we're going to do our 8-pillar analysis. For the previous 1,300 videos we did it line by line, every single 8-pillar. What we're doing now is we're going right to the 8 pillars page on our website, our exclusive website. And then at the end of the video, Seth will show you how you can learn more about our 8 pillars. There is a separate video he'll send you to that'll explain our 8 pillars very specifically and very much more in depth. That way you can get a better understanding of it. Now, to make it easier for people to see, I'm going to actually put this in dark mode. That way it's easier for our camera. So there we go. Okay. First thing I start with before we go on, it's a $2 trillion company. It's not 1.8 trillion. It's 2 trillion. No dividend at all. So that's the first initial stuff I look at. Now we go to our 8 pillars tab here. So the 8 pillars tab right here. So guys, Sethi, what do you have here?
Oh, okay. So this is typical overvaluation with their 2 metrics.
So guys, these 6 basically tell me how they operate the business. Our return on invested capital is getting better. It is high. Revenue growth is growing. Net income growth. Shares outstanding. They're buying back shares. They have very little debt. Look at this, Seth. They can pay off their debt with 1 year of their last year's cash flow and their cash flow growth. The first and 8th pillar are all about valuation. How is the market perceiving them? So this tells me the market thinks there's a lot of growth potential, a lot of good upside to Google. The question is that true or not? I don't know. This could very well be a cheap price. As I always tell people, if you have 2 companies with exactly the same financials, everything, and one's growing 20% a year, one's growing 5% a year, which one should you pay more for?
Obvious,
a 20% one. And that's what we try to focus here. When people say on the other comments, Paul doesn't understand, growth is the most important aspect to me in any valuation of any company. It's the future. We don't know what the future is going to be. All I say is, 1, don't assume amazing growth, and 2, don't overpay for that growth. So that's why you have a stock analyzer tool. So what we're going to do here with the stock analyzer tool, guys, the future is unknown. Every investment is the present value of all future cash flow. We're going to put our assumptions for the future in the stock analyzer tool, and based on those assumptions, it'll tell us what we should pay for the company based on those assumptions. So stock analyzer tool, let me make this a little bit bigger. All right, first thing I'm going to do is I'm going to do a 10-year analysis on Google because something tells me Google will still be a very dominant force in 10 years. Now, guys, this is the 1, 5, and 10-year numbers. Look at these growth numbers. It's actually gotten better in the last 5 years versus the first 5. And last year they had a big jump. But my goal is to be conservative. There are 10,000 companies out there. I'm reading this book called Essentialism, and it's talking about hiring people. Mm-hmm. And they basically say, or doing something, they basically say, if it's not an obvious yes, it's a no. And I think value investing is the same way. I'm
learning this from you, Paul, because we've talked about expanding our show. We hire people to help edit, make designs. And sometimes I swear it comes down to like the first 30 seconds of a conversation. You can almost tell if someone's like cool or not, right?
Yeah, absolutely. You're going to know, if it's not an obvious yes, it's a no. But it's not just for hiring. I think that same way for investing. To me, there are 10,000 stocks out there or more to invest in. If it's not an obvious yes, move on. Now, does that mean in the first 10 seconds? No, but you should have a pretty good idea as you get your process down on what the things you're looking for are. Okay? Mm-hmm. So I'm going to make some conservative assumptions. 8, 11, and 14% revenue growth. Is that low? Absolutely, that's low. It's absolutely low. But again, I'm trying to be conservative, and I want to really focus on the middle range numbers here. Profit margin. Okay, now they had a fluke year here, guys. Look at this fluke year. Last year was a big fluke. The previous 5 and 10-year numbers are very similar. So I'm not going to focus on this 1 year number. So I'm going to go 21.5, 22.5. Let's say they kill it and they go to 23.5% profit margin. Free cash flow, basically the same thing because their numbers are pretty similar. PE. Now this is where I'm going to get some crap. Guys, the PE is currently 28. Guys, Google's so big. Yes, it's dominant, but I don't think you can assign a huge PE to it. I'm going to go 14, 16, and 18. And same thing with free cash flow. And finally, 12.5% return. The reason being is you can invest in an ETF and get 9 or 10% return a year. So if you're going to do the work and have an individual company and have margin of safety, put 12.5% in. That gives you enough ample room for margin of safety. Hit the analyze button. And no surprise here, guys, even on the highest level, even on the best assumptions I have here, it's still not justifying today's price. And I'm pretty much it's got to drop a third. Now, look at this. The PE is 28. If it dropped a third, it would take it to basically 19 PE, which is still an aggressive PE for a company that's so large. But does it have a lot of potential? I mean, the biggest market in the world is China. Did China ban Google?
Yeah, right.
We have to look that up. But I mean, there is a lot of growth potential for Google. And by the way, I usually say tech is very cyclical. Who's going to overtake Google? I mean, Google has YouTube. The top 2 search engines in the world are Google and YouTube, and Google owns both of them.
And they're so different, like.
Oh yeah, one's for. I mean, but they're so different, but they're not different.
Yeah, it's like if I need to find info, some things you just can't look up on Google, as opposed to just I want to see somebody do this, like how to do this or do. So here you go. We're
so ingrained in Google.com. We just say Google it. Does that mean it's going to be around forever? I don't know, but I look at it going, man, it's going to be a tough one. So with that said, do I think you can go higher in your assumptions? Yeah, I think Google's the kind of company where there's a big moat there. Talk about the Warren Buffett moat. There's a big moat there. So guys, we have confirmed China did block Google. Guys, remember one thing I've been saying a lot in the last few weeks. You can never change the price you pay for something. The second you pay this price for the stock, this is your investment. All your returns are going to be based on this price. If it's a great price, awesome. If it's not a great price, be patient. So let's change the assumptions just a little bit. Let's do revenue growth, 10, 13, and 16%. I'm going to keep profit margins the same, but let's change our PE, 16, 19, 22. 16, 19, 22. Analyze. Just now, we're getting into it's justifiable. On the middle range, you still need a 20% pullback from today to justify this. And again, if you do more research on Google, this is a 500-foot view. For me, I'm adding this to my watch list, which is coming soon in our software. I look at this going, this is a stock I want to own in the future, but just at a cheaper price. That's it. Very simple.
Quite often I'm in part of some Facebook groups. I like to get the common man's and woman's opinion. And people sometimes they just flippantly say, Google's a buy every day. It's ingrained in our lives. It's just a buy. Stock split or not, just, go for it. And I kind of wince because I think that's how normal people somewhat feel, Paul, is like, forget the numbers, forget it all. Well, they said this about Netflix many years ago, but just like, the hell with it, Google's a buy. Like, I guess, how do we get our message out to more people?
Okay, when somebody says that, what you're essentially saying is, there is no price that's too much. Great, $10 trillion. Well, wait a second. Okay, so you are willing to admit there is a price that's too much. We're just differing on where that price is. You sit there and by the way, I guarantee if your mentality is there's no price too much, if Google hit 10 trillion, you'd have a justification for why Google's still a buy at that point. It's a mentality. Just like everybody here knows people who are excuse makers. If you eliminate their excuse, oh my gosh, if only I had $1 million, I would be so successful. Life would be easier. Great, here's $1 million. They'd be broke and unhappy still. And then you'd say they had some other excuse. No different here. If Google was a $10 trillion company, if you believe that Google is just amazing, you just sit there and say, well, yeah, obviously it's going to keep going. Look, it's 10 trillion, but it was obviously justified. The difference between you and me is I think the justification is a lot lower. You just don't have, well, there's a lot of difference between you and me. I'm smart, you're not. If you really say that any prices, it works.
Yes.
That's the case, please come by my house. Please come by my house.
You're selling it?
But buy my company. Buy my company, because I guarantee you my company has more growth potential than Google does. They do 150 billion, whatever they do in revenue. I do 20 million in revenue. Please come buy my business because you'll pay through the nose for it. I will gladly sell you my business for the same valuations. That's it. It's not much more different than that, and that's just how it works.
Be careful out there if you're drawn to Google. You can certainly day trade it. You can join the Bid and Ask Nation. If you're drawn to this style of investing, you can have the software behind Paul. Paul, tell them how they get it. Go ahead, baby.
All right, so we created this software because as we were doing this analysis early in our videos, our users were saying, hey, how do I get this data behind you? So we hired 4 or 5 developers, spent hundreds of thousands of dollars, and created the software. You get everything you saw here on your mobile phone. It's not just on desktop, it's on your mobile phone, easy access to it. You get everything listed here: 8 pillars, retirement calculator, stock analyzer tool, 8-pillar portfolio, exclusive video content. Every single day, we send out one or two videos to our users. It's only available if you subscribe. And all of these things are coming that you get included. But most importantly, you get the community of over 6,000 members who are there to talk about investing. So many people felt alone in investing because you have these value investing ideas, but you have nobody to talk to about it. This allows everybody to come in. Thousands and thousands of messages are exchanged every single day talking about everybody's investment ideas, even crypto, even Tesla. People on there disagree with me on them. This is all for $1 per day. Less than a cup of coffee, guys. $1 per day. If you can increase your returns by 1 or 2% a year, or even better, decrease your losses by 1 or 2% a year, this will increase your net worth by hundreds of thousands, if not millions, by the time you retire. This is a no-brainer, guys. $1 per day, all available on your phone. Sign up. 2 ways to sign up: everythingmoney.com or Patreon. The benefit of going directly to everythingmoney.com is there is no sales tax charged yet because we're not big enough. So go sign up. No brainer. Get on it. $1 per day.
Don't fall in the trap of investing in a company just because they split. And if you need more help, we'll be here to guide you. That's our take. Fondle the thumbs up, as I always ask, and we'll see you next video. Thanks for watching.